Most people think financial freedom is out of reach because the number just feels too big. $1 million? Maybe two? Enough to make you think, why even bother? But here's the thing. The real amount you need to live off dividends is way lower than what you've been told. In this video, I'm going to cut through the noise. First, I'm going to show you and John a realistic look at where most Americans are financially today and how SCHD can help solve that problem. We'll look at how SCHD keeps itself updated year after year and take a look at its past performance. We'll cover the challenges with dividend investing. And at the end, I'll walk you through two investment paths that show the lowest amount you'll need to reach $5,000 a month in dividend income with SCHD. One is a simple one-time set-it-and-forget-it investment, and the other is a single-digit daily amount to reach the same goal. Now, before we talk about living off dividends, we need to step back and look at where most people stand financially in 2025. The U.S. economy looks stable on the surface. GDP grew about 3.8% in the second quarter of 2025, inflation cooled to 2.7%, and unemployment held at around 4.3%. But for everyday households, it doesn't feel stable at all. That's because the essentials, rent, groceries, healthcare, transportation, continue to climb faster than paychecks. Take rent, for example. The median cost of renting a two-bedroom apartment in many U.S. cities has now pushed past $1,500 a month. And in high-demand areas, it's well over $2,000. Add in rising bills and groceries with food prices up more than 20% compared to 5 years ago, and it's no wonder families feel stretched. The result is a nation that's struggling to save. The personal saving rate is just 4.5%, according to the Bureau of Economic Analysis. Think about what that means. A family earning $80,000 a year might only manage to save around $300 a month. That's barely enough to cover a car repair, let alone build meaningful retirement savings. And the retirement numbers back this up. The Federal Reserve's 2025 survey found that only 67% of adults even have a retirement account, and just 35% are on track with their savings goals. Among younger workers under 30, fewer than 4 in 10 have retirement savings, and only 23% feel on track. Even for those in their late 50s approaching retirement, less than half are confident they'll have enough. That means even after decades of working, many are still unprepared. This is why the idea of dividend investing catches people's attention. Instead of relying only on your wages or hoping that savings will stretch, you instead build an asset that pays you. And one of the most popular tools for making that happen is SCHD. So what exactly is SCHD and why does it get so much attention when people talk about living off of dividends? Well, SCHD stands for the Schwab U.S. Dividend Equity ETF. If ETF sounds too technical, here's the easy way to think about it. Instead of buying just one company's stock, you're buying a basket of over 100 strong U.S. companies all at once. It's like grabbing a pre-packed grocery cart filled with only reliable dividend-paying brands instead of wandering aisle by aisle trying to pick winners. Launched in 2011, SCHD has built a huge following. Today, it manages more than $70 billion. That means it's not some niche product, it's one of the most popular dividend-focused ETFs in the US. So what makes SCHD stand out? Well, first, the income. Right now, it pays a dividend yield of about 3.8%, and that's cash hitting your account 4 times a year. Second, it's cheap to own. The expense ratio is just 0.06%, meaning that for every $10,000 invested, fees are only $6 a year. That's far lower than most actively managed funds. And maybe the best part is the simplicity. You don't need to track dozens of individual stocks or stress over which company is worth holding. With just one ticker symbol, SCHD, you get access to companies that not only pay dividends but also have a history of steadily increasing them. Investors love SCHD because it balances income and growth. It's not about chasing risky sky-high yields. It's about steady cash flow, consistent raises, and long-term compounding, all wrapped into a single low-cost fund. One of the smartest features of SCHD is that it doesn't just sit still. Unlike buying individual stocks where you're stuck monitoring every company yourself, SCHD has a built-in system that automatically keeps its portfolio fresh and updated. Here's how it works. Once a year, every March, SCHD goes through a rules-based rebalancing process. That means each company in the fund is graded using strict criteria, things like cash flow, return on equity, consistency of dividends, and overall financial strength. If a company no longer makes the cut, it gets removed. At the same time, new companies that do meet the standards are added in. We've seen this in action. Over the years, companies with weakening fundamentals like Walgreens or IBM were dropped. In their place, stronger dividend growers such as Broadcom and Amgen were brought in. That consistent refresh is what helps SCHD stay aligned with its mission, focusing only on financially healthy, reliable dividend payers. The turnover rate, or how much of the portfolio changes, is usually around 29% a year. That's enough to show SCHD is actively improving itself, but not so high that it feels unstable. For investors, it's a huge relief. You don't have to constantly babysit your portfolio or wonder if you're falling behind the market. SCHD does all of the hard work for you. This self-correcting feature is one of SCHD's biggest strengths. It saves investors from the tough decisions of when to sell and what to buy next while keeping the ETF focused on dependable, growing income. Now that we know what SCHD is and how it keeps itself fresh, let's talk about how it has actually performed and the risks that come along with it. Over the short term, SCHD has had its ups and downs. In the last year, the fund has been down about 2.56%, reflecting broader market volatility. But if you zoom out, the picture looks much stronger. Over 5 years, SCHD delivered a 47.08% total return. Stretch it to 10 years and the growth is even more impressive, up 121.9%, more than doubling your money while also paying dividends along the way. And dividends are where SCHD shines. Right now, it offers a yield of around 3.81%, higher than the broader S&P 500. But it's not just about the yield today, it's about the growth. Over the last decade, SCHD's dividends have grown at an average annual rate of about 10.43%. That's like getting a raise every single year, and it means the income stream has consistently outpaced inflation. Now listen, at the end, I'm going to show you 2 paths to $5,000 a month in SCHD dividends, a one-time investment path, a daily contribution path, and the investment required to reach the $5,000 a month. As for SCHD Holdings, it holds around 103 companies, with the top 10 making up about 40% of assets. Some of the biggest names include AbbVie, Chevron, ConocoPhillips, Home Depot, Lockheed Martin, Cisco, Verizon, Amgen, Altria, and Coca-Cola. In terms of sectors, it leans on energy at nearly 20%, consumer defensive at about 19%, and healthcare around 16%, with industrials, technology, and consumer cyclical making up most of the rest. On the other hand, no investment is risk-free. SCHD carries an annualized volatility of about 16%, which is normal for an equity fund, but still means prices can swing. The sector concentration is another consideration. Heavy exposure to energy or healthcare can help when those industries thrive, but it can also drag performance when they struggle. The good news is that SCHD is highly liquid, trading more than 16 million shares daily. It's cheap to own, easy to buy and sell, and built to deliver steady, growing income over the long haul. By now, SCHD sounds like the perfect setup. A proven fund, steady dividends, solid growth, what's not to love? But here's the catch that trips most people up when they start thinking about living entirely off dividends. On the surface, a 3.81% yield sounds great, but when you run the numbers, the reality can feel discouraging. Let's say you invest $100,000 into SCHD. At today's yield, that generates about $3,810 a year, or just over $317 a month. That's not enough to cover groceries for most families. So how much would you really need to generate $20,000 a year in dividends? You'd need around $525,000 invested. For $40,000 a year in dividend income, the number jumps to about $1.05 million invested. And for $60,000 a year in dividend income, which is close to the median U.S. income right now, you'd need more than $1.6 million invested in SCHD. When people see numbers like that, $500,000, $1 million, even more, it feels like staring up at a mountain with no way to climb it. That's the point where many throw up their hands and think, okay, this investing thing is not for me. But that's not the full story. Because here's the part most people miss. SCHD doesn't just pay the same dividend forever. Its payouts have historically grown year after year. Like we mentioned a couple of minutes ago, the dividend growth rate is 10.43%. That means the income you start with today can become a lot bigger 10 or 20 years down the road, even if it feels small in the beginning. And the effect gets even stronger if you reinvest those dividends instead of spending them right away. Every dollar reinvested buys more shares. Those shares generate more dividends, and those dividends buy even more shares. Over time, that snowball effect takes over. It starts slow, but eventually the growth compounds to levels that surprise most new investors. So yes, seeing that $1.5 million figure can feel overwhelming, but the truth is, you don't need that sitting in your account today. With time, consistency, and the magic of compounding, the climb gets a whole lot easier than it first looks. And that's where the two biggest factors come into play: how much you start with and how much time you give your money to grow. Let's start with the obvious one, starting capital. If you invest a large lump sum up front, the results show up quickly. For example, someone who puts $500,000 into SCHD today would immediately generate close to $19,000 a year in dividends at the current yield. That's meaningful income from day one, but most people don't have $500,000 sitting around, and that's where time becomes the great equalizer. With enough time, even smaller, consistent contributions can grow into something massive. Suppose you set aside $250 a month, about the cost of a daily coffee and lunch out. After just a few years, it doesn't feel like much, but stretch that out over 20 or 30 years, and thanks to compounding, the numbers snowball into life-changing income. This is where the old saying comes true: time in the market beats timing the market. Waiting for the perfect moment to invest doesn't matter nearly as much as simply starting early and staying consistent. Another way to look at it, small contributions made early often beat big contributions made late. A 25-year-old investing a modest amount each month into SCHD will almost always end up with a larger portfolio than someone who waits until age 45 and tries to catch up with much bigger deposits. Time does the heavy lifting. So here's the trade-off. If you have less time, you need more money up front. But if you have more time, you can start smaller and still reach the same destination. To see exactly how this plays out, let's look at two different examples, one with a single lump sum investment and one with daily contributions. Let's start with the one-time investment example. Let's say John invests $25,000 into SCHD up front and just lets it run. What does it look like over time? By the end of the first year, the portfolio would be worth around $28,140, and John would be collecting about $953 in dividends. It's not a life-changing amount, but it marks a strong start. By year 10, growth becomes more visible as the portfolio climbs to roughly $83,827, while annual dividends reach around $3,278. By year 20, the portfolio is projected to grow to about $300,202 with yearly dividends of $13,772. Then comes the breakthrough with compounding growth. By year 30, the portfolio reaches $1,161,360 and annual dividends of around $62,417 or about $5,200 per month in passive income. The total value added to the portfolio comes to about $1,136,360. Breaking that down, $694,540 comes from capital appreciation, while $441,820 is generated from reinvested dividends. This means dividends alone account for nearly 40% of the total value added, underscoring how reinvestment is just as important as share price growth for building long-term wealth. Okay, but what if you don't have $25,000 lying around to get started? Well, that's the reality for most people. So let's look at another path. What happens if you just invest about $9 a day into SCHD? Here's what the projections show. By the end of the first year, John would have invested around $3,285. By year 10, the portfolio is projected to grow to around $60,414, while annual dividends reach about $2,234. Fast forward to year 20, and the portfolio reaches nearly $279,054, and annual dividends climb to around $12,651. And by year 30, the snowball pushes the portfolio to $1,145,058, with dividends topping $61,364 annually, which is more than $5,100 every month. The equivalent of a solid salary, completely passive, while your principal continues to grow. The total value added to John's portfolio comes to about $1,046,508. Breaking that down, $636,652 of that comes from capital appreciation, while $409,508 is generated from reinvested dividends. Want to know the fastest way to reach $3,300 per month in dividends? Click the video on the screen to find out.